A margin account allows you to borrow money from your brokerage to buy stocks. Let's look at how it works and the risks involved. In finance, margin is essentially leverage. It lets you control more shares than your cash balance would normally allow. The Federal Reserve sets rules for margin. Generally, you must provide 50% of the total purchase price yourself. When you use margin, your existing securities act as collateral. Remember that you pay interest on the loan, which can eat into returns. A standard cash account limits you to your own funds, while a margin account introduces borrowed capital and higher risk. If a stock price rises, margin can double your percentage return. However, if the price drops, your losses are also doubled. The golden rule of margin is to never borrow more than you can afford to lose, as market volatility can trigger a margin call. Margin accounts offer flexibility but carry significant risk. Always check your broker's specific interest rates. Thanks for watching.